They didn't do it with a press conference. They didn't do it with sirens. They didn't do it with a warning label on your trading app. They did it the way the system always does it, quietly, in a government statement, in a list, in a licensing decision that most people will never read. And now you're seeing the consequence. Silver didn't randomly surge. Silver didn't get lucky. Silver didn't wake up and decide to go vertical. This move has a cause. And if you understand that cause, you stop being the person who panics at the top and sells at the bottom and then watches it rip without you. Because the latest news is simple. China has tightened the pipe. And when the pipe tightens, the whole world fights over the remaining flow. China's Ministry of Commerce has now named the companies that can export silver for 2026-2027, and the number is 44. And here's the part most people are missing. This isn't just some policy, this is a signal. It's China saying, we consider this metal critical to our industries. And the moment the market hears that, the psychology flips from silver is a commodity to silver is a strategic material that can be gated. And when a commodity can be gated, price becomes a weapon. So in this emergency-style breakdown, here's what we're doing. I'll explain what China actually did, without hype. I'll show you why this creates a supply panic, even if you never buy a single coin. I'll break down the East-West split, why paper price can lag while physical goes feral. I'll give you a clean playbook, signals to watch, levels to respect, and mistakes to avoid. Because this isn't a feelings market. This is a mechanics market, and if you can read the machine, you don't get emotionally farmed by the candles. Let's be precise. A lot of people are using the word ban. What China actually did, based on the reporting, is restrict who is allowed to export silver. Reuters reports that 44 companies will be allowed to export silver in the 2026-2027 period, per the Ministry of Commerce. So call it what it is, a narrowing of the Chuko Gate, a licensing choke point, a controlled valve. And you might say, wait, 44 companies is still a lot. No, not in a world where supply chains are brittle, not in a world where industrial demand is non-negotiable, not in a world where solar, electronics, defense, data centers, EVs need real ounces, not opinions. And Reuters makes the framing clear. These are metals Beijing deems critical to support its own industries. So this is not just economics, this is industrial strategy, and the market doesn't wait for shortages to show up in headlines. The market front runs, the market panics early, the market buys first, and asks questions later. That's why you're seeing the surge behavior. Why this creates a global supply panic. Here's the key idea. Silver is a small market with a huge job. Gold is mostly monetary. Silver is monetary and industrial. Silver is the metal that sits inside the real economy. It's the wiring, the paste, the contacts, the conductivity. So when export rules tighten, the fear isn't, oh no, investors can't get coins. The fear is, manufacturers can't plan. Refiners can't quote confidently. Dealers can't replace inventory. Supply chains can't guarantee delivery. And the second the market senses uncertainty, everybody does the same thing. They move from just in time to just in case. They overorder, they hoard, they lock supply, they pay premiums. And that's how you get a surge. Not because the world fell in love with silver overnight, but because the world started fearing a future where silver is harder to source on demand. The surge context, how wild this market already is now, zoom out. Silver has already been in a historic run. Reuters reported that silver posted a massive 2025 surge and hit an all-time high around $83.62 earlier this week. And yes, after spikes, you often get violent pullbacks, margin shocks, and profit-taking. But what matters here is not whether it's up on the day. What matters is the regime changed. We're in a world where strategic policy moves matter, physical premiums matter, and deliverability matters. And there's another important layer. The U.S. has also started treating silver as strategic. The U.S. Geological Survey's final 2025 critical minerals list added silver among new minerals. So now you have something rare. Both sides of the global industrial order are signaling this matters. And when two giants say a thing is critical, markets reprice the risk. The East-West split. Why paper can lie while physical screams. Now we go to the part that separates pros from tourists, because the silver market has two realities. Paper reality, futures, leverage, liquidity, margins. Physical reality, bars, coins, industrial offtake, inventory. And when supply tightens, these can decouple. Business Insider reported that the spread between spot silver in Shanghai and in London briefly rose to more than $8 an ounce, described as the largest premium the metal has posted in China, citing Bloomberg data. Read that again. More than $8. That is not noise. That is a distress signal. That is the market saying, deliverable metal is worth more here than it is there. And when that happens, you get the vacuum effect. Metal moves. Arbitrage wakes up. Vaults drain. and the paper market starts sweating because paper can't print atoms. So if you want the cleanest truth meter in this story, it's this. Watch the premium, not your feelings, not the influencer hype, the premium. Because premium is the cost of certainty, and uncertainty is what rules like this inject. But why would Elon Musk care? Because industry can't substitute fast now, a moment that tells you this reached the mainstream industrial conversation. Elon Musk amplified concerns about silver's industrial importance, with coverage noting the message that silver is needed in many industrial processes as China's export rules tightened. Whether you love Musk or hate him, doesn't matter. What matters is what this indicates. This story is no longer trapped inside silver Twitter. When industrial leaders publicly react to supply risk, it pulls attention. It pulls procurement teams, it pulls headlines, and procurement teams don't buy like traders. They buy like survivalists. They don't ask, will it dip tomorrow? They ask, can we secure 6 months of input? That is a different kind of buyer. That buyer creates floors. The COMEX problem, where this turns into a delivery story. Now let's talk about the Western machine. COMEX futures are a price-setting mechanism, but they're also a delivery mechanism. And the fear in a tightening physical market is simple. What happens if too many people demand delivery at the same time? That's not a conspiracy question. That's a structural question. Because if East-West arbitrage keeps pulling metal and inventories stay tight, then Western vaults can face stress. And in stressed markets, two things happen. The price spikes violently to ration demand. The system finds ways to reduce delivery pressure, cash settlement incentives, spreads, rule changes. And if you're a retail holder, here's why you must understand this. The most violent upside moves in commodities happen when physical is tight, paper is short or over-levered, and a delivery or procurement panic hits at the same time. That's not a chart pattern. That's a structural squeeze. The liquidity weapon. Why you can still get dumps in a bull market. Now listen carefully. Even with bullish fundamentals, you can still see brutal dumps. Why? Because paper markets are run on collateral. And we literally just saw what margin does to this metal. CME published new performance bond, margin requirements effective after DQ 26, 2025, effective DEC 29, 2025, showing COMEX 5000 silver futures margin increases, for example, maintenance, initial figures stepping up to around $25,000 in that notice. That is the long squeeze weapon. It forces selling from the fragile part of the market, over-leveraged traders, oversized positions, late-stage momentum chasers. So here's the emotional trap. People see bullish news, they buy leverage, then the rules change, and the market takes their position. And then, after the weak hands are gone, price can resume the bigger move. So don't confuse dump with thesis broken. In commodities, dumps are often cleaning events. Okay, so why did price surge now? Let's connect the chain. China tightens the export gate via licensing. Market reads it as strategic. Physical buyers in Asia pay up, premiums widen, business insider arbitrage pulls metal. Western market realizes paper is cheap, physical is not. Procurement gets nervous. Investors front-run the fear. And that is how you get the surge psychology. Not magic, mechanics. The 3 layers of this trade, so you don't get confused. When you watch silver, you're watching 3 layers at once. Layer 1, macro money, dollar strength, rates expectations, risk on-off. Layer 2, paper structure, margins, positioning, liquidation cascades. Layer 3, physical constraint, premiums, inventories, delivery demand, procurement panic. Most people watch only layer 2. That's why they get whipsawed. If you want to stop taking emotional damage, you track all 3. What to watch right now? Your panic vs. real checklist. Here's your no-hype checklist. Signal A, Shanghai premium. If premiums stay wide or widen further, physical tightness is real. Signal B, policy follow-through. If the export list stays tight and enforcement looks serious, the market will keep pricing scarcity risk. Signal C, inventory headlines arm delivery stress. You're looking for language like tightness, low inventories, delivery premiums, allocation, delays. When those words show up, it's not about charts anymore. Signal D, the margin lever. If volatility returns and margins rise again, expect shakeouts, even inside an uptrend. Signal E, gold confirmation. Silver amplifies gold. When gold moves, silver exaggerates. The most important idea? Price is not always cost. Let me reframe this in one line. The screen price is what traders argue about. The street price is what industry pays. And industry sets the floor in shortages. Because factories don't care about your RSI. They care about keeping the line running. How the market steals your position. Here's how the market steals your position. Bullish news hits. Everyone gets excited, price pops. Retail piles in late, margin rules tighten, or liquidity dries up, price dumps hard. Retail panics, sells. Smart money accumulates into the fear. Then the market rips again, and the crowd watches from the sidelines talking about manipulation. It's not mystical, it's positioning. So your job is simple. Don't be the liquidity for someone else's accumulation. Scenarios. What happens next? No prophecy, just maps. I'm giving you 3 regimes, not predictions. Maps. Regime 1, the continuation, rip, premiums. Stay hot, dips get bought instantly. Price makes higher lows. This is what a real panic bid looks like. Regime 2, the violent whipsaw. Bullish news stays true, but paper structure causes dumps. Margin positioning creates intraday terror. This is the market cleaning leverage while staying bullish. Regime 3, the temporary cool-off, premiums narrow, slightly price chops, market digests the shock. This is consolidation before the next macro catalyst. Your job is not to predict which one. Your job is to recognize which one is happening, fast. Key levels. How to think without being a robot. Let's talk levels in a way that actually helps. I'm not drawing pretty lines to feel smart. I'm identifying the zones where behavior changes. Prior highs matter because they're where late buyers are trapped. Round numbers matter because humans anchor to them. The real support is where buyers step in hard, over and over on heavy volume. And if you want one mental model, support is not a line. Support is a behavior. When price hits a zone and buyers slam it, that's support. Why the export move matters even if you never touch China, because the silver market is global. If Asia pays more, metal flows there. If metal flows there, Western inventories tighten. If Western inventories tighten, COMEX delivery risk rises. If delivery risk rises, shorts get nervous. If shorts get nervous, they cover. And when silver shorts cover, it doesn't move politely. It gaps, it spikes, it rips your face off. That is silver's personality. What this means for 2026, the strategic metal era. Here's the bigger story. This isn't just a trade anymore. It's the beginning of a new era where silver is treated less like an industrial input and more like a strategic resource. China is openly framing critical minerals as leverage in a broader geopolitical and industrial contest. The US is formally elevating silver's strategic importance through its critical minerals framework, so you have synchronized signaling. That is rare, and when that happens, the market starts pricing. Supply security, national stockpiling, controlled exports, and procurement competition. That's how commodities go from normal to unstable. The physical reality. Check. The test you should always run. Here's your simplest test. When price moves, ask, did physical follow? Are premiums rising or falling? Are dealers sold out or stocked? Are delivery times stretching? Are spreads widening between regions? Because if physical stays tight while paper dips, that dip is often a gift, not always, but often. And the people who win in commodity cycles are the ones who can tell the difference between a liquidation dip and a demand collapse. This, right now, does not look like demand collapse. This looks like constraint fear, how to not lose your mind. Emotional capital rules. Let's talk like adults. This market will mess with your head. Silver is not a cleanup trend asset. It's a weaponized volatility asset, so protect your emotional capital. Stop staring at every candle. Stop anchoring to the top tick. Stop confusing today with forever. And remember, if you didn't sell, you didn't lock anything. A drawdown is information, not a verdict. What I'm watching over the next 72 hours. Here's the short list. Does the Shanghai premium stay elevated? Do headlines confirm the export gate remains tight and enforced? Do we see more mainstream industrial concern, like the Musk-style reaction? Does volatility trigger more paper shakeouts via margin or positioning? Does gold confirm the macro direction? That's the map. The big warning. Don't let the market steal your fruit. Let me end where we began. This was not random. This was not luck. This was a structural story changing in real time. China tightens export access and frames critical minerals as strategic. Physical premiums spike and show stress across regions. The US elevates silver's strategic status too. That is the recipe for supply anxiety, hoarding behavior, procurement panic, and violent price discovery. So here's the final message. Don't trade this like a meme. Don't trade this like a lottery ticket. Don't trade this like a one-day chart. Trade it like what it is, a strategic metal entering a strategic era. If you want me to do a part 2 where I break down the COMEX delivery mechanics in plain English, what registered versus eligible actually means, and the exact squeeze triggers that would force a disorderly move, then comment delivery map and I'll make it the next upload. And if this helped you stay calm in a loud market, hit the like button, subscribe, and send it to one person who's panicking right now, because the market loves panic, and we're not feeding it.